Washington, D.C. has just dropped a bombshell on the crypto markets. Today, I'll be giving you a rundown on the newly signed Genius Act, which is set to fundamentally reshape the future of cryptocurrency in the United States. On Friday, July 18th, 2025, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or Genius Act for short, was officially signed into law. And if you're a seasoned crypto investor or just getting started, you're going to want to understand what this means for your digital assets. So what exactly is the Genius Act? Well, in a nutshell, it's the United States' first major piece of federal legislation specifically targeting stablecoins. Now, what are stablecoins, you may ask? Well, they are a type of cryptocurrency specifically designed to maintain a stable value by pegging its market price to an external, less volatile asset. Most commonly a currency like the US dollar, aiming for a one-to-one value. So what does this bill actually do? Well, first and foremost, it sets strict reserve requirements. This is a big one. The days of wondering what's really backing your stablecoins are numbered. The Genius Act mandates that all licensed stablecoin issuers must hold one-to-one reserves in cash or cash equivalents. This is a direct shot at preventing the kind of collapses we've seen in the past with algorithmic stablecoins, which instead of holding underlying assets, use complex algorithms to regulate supply and thus regulate the price. Next up, we have strict licensing requirements. If you want to issue a stablecoin in the United States, you will now need to get a license from either a state or federal regulator. This is designed to bring stablecoin issuers into the formal financial system and subject them to regular audits and oversight. The bill also seeks to enhance consumer protections. The Act introduces a host of new rules aimed at protecting consumers. These include clear and transparent marketing standards, requirements for public disclosure of reserves, and provisions to ensure that in the event of an issuer failure, stablecoin holders are the first in line to get their money back. Now, it's important to point out that this bill's regulations are narrowly focused on stablecoins, with the decentralized cryptocurrencies like Bitcoin and Ethereum being largely unaffected. For context, the market's two largest stablecoins, Tether, USDT, and USD Coin, USDC, collectively account for over 80% of the total stablecoin market capitalization. So if you were thinking that these regulations would affect cryptos like Bitcoin and Ethereum, good or bad news for you depending on your perspective, they do not. Now, you may be wondering why someone would even want to hold their money in stablecoins. It does seem a bit counterintuitive to hold a digital asset pegged to the dollar instead of the dollar itself. But the thing is, the benefits of stablecoins have little to do with earning returns and everything to do with what they enable you to do with your money. For many, the advantages of speed, cost, and access to the digital asset economy far outweigh holding cash in a traditional bank account. For example, stablecoins operate on blockchains, which are global 24/7 financial networks. This offers a significant advantage over the traditional banking system for a number of reasons. For instance, a bank wire or international transfer can take several business days to settle. A stablecoin transaction, however, can be sent and received within minutes or even seconds, regardless of weekends, holidays, or banking hours. Along with that, international money transfers often involve high fees from intermediary banks and unfavorable currency exchange rates. Stablecoin transactions bypass these, reducing the cost to a fraction of traditional methods. For those who are involved in the cryptocurrency market, stablecoins are an indispensable tool. Holding USD in a bank is external to the crypto ecosystem, making it slow and cumbersome to use for trading. Stablecoins, however, act as a bridge asset on crypto exchanges. Traders can quickly move out of a volatile cryptocurrency like Bitcoin into a stablecoin to lock in profits or wait out market turbulence without having to cash out to a bank account. This allows them to stay liquid and ready to re-enter the market at a moment's notice. They also open up the world of decentralized finance, which offers opportunities for lending, borrowing, and earning interest on your assets. Stablecoins are the primary currency used in these protocols. You can lend your stablecoins to others and earn interest rates that are often higher than what traditional savings accounts offer. And finally, stablecoins provide a crucial alternative for individuals in countries looking for less volatile asset exposure. For example, people in nations where the local currency is unstable and rapidly losing value, a USD-pegged stablecoin offers a way to protect their savings from hyperinflation. In many parts parts of the world, access to traditional banking services, especially those that can hold US dollars, is limited. Anyone with an internet connection and a smartphone can create a digital wallet and hold stablecoins, giving them access to a stable currency and the global financial system. So while a stablecoin may have the same value as a dollar, it is faster, cheaper to move, and provides a gateway to digital financial services. So what's the reaction been? Well, as you can imagine, it's been a bit of a mixed bag. Well, supporters, including many in the crypto industry and a bipartisan group of lawmakers, are hailing the Genius Act as a massive step forward. They argue that this will bring much needed legitimacy to the space, attract institutional investment, and solidify the US dollar's dominance in the digital age. With the rationale being that if more people or countries opt to use USD-backed stablecoins as a payment method, it would create more demand for the underlying asset. On the other hand, there are critics. Some are concerned that the law could stifle innovation by creating high barriers to entry for smaller startups. Others worry that it doesn't go far enough in addressing the potential risks that stablecoins could pose to the broader financial system. So, what does this all mean for you? Well, for starters, if you hold stablecoins from issuers who become licensed under this new act, you can expect a greater degree of security and transparency. The risk of a major stablecoin depegging should, in theory, be significantly reduced. Now, what the heck is depegging? Well, I'll break it down for you. This phenomenon occurs when a stablecoin's market value deviates significantly from its pegged asset, to which it's supposed to maintain a 1-to-1 ratio. This can happen for a variety of reasons, including the loss of confidence in the issuer's ability to maintain adequate reserves, which could trigger a bank run style sell-off. Market volatility and technical glitches within the underlying blockchain can also contribute to a depegging event. The Genius Act seeks to eliminate this type of scenario from happening. It is worth noting that tension does exist within the crypto community regarding regulation. While many early adopters see it as a deviation from the original goal of decentralization, a growing number of proponents now welcome regulatory clarity. They believe that well-defined rules are a crucial stepping stone towards achieving mainstream adoption and legitimacy as both an asset class and a payment system. The Genius Act is without a doubt a watershed moment for the crypto industry. It's the first major attempt by the US government to create a comprehensive regulatory framework for a significant part of the digital asset ecosystem. Will it be the perfect solution? Who the heck knows? The long-term impact is still very much up for debate, but one thing is for sure, the Wild West days of stablecoins in the United States are officially over. A new, more regulated chapter has begun. Now, before I head out, let's take a quick look at those two stablecoins I mentioned earlier. So here we are on coinmarketcap.com. Right now we're taking a look at Tether here, or USDT, which is standing right around that $1 per coin mark. If we take a look here at this graph, we can see that there was a dip. This is over the last 7 days. There's a dip here, and now it's up. But when we take a look at sort of the variance here, well, we have 0.99958. and a high of 1.0009. So effectively speaking, this has done a pretty good job of staying close to that $1 per coin mark. Now, if we look over here, we've got USDC. This is another stable coin right here, just under $1, but effectively, I would say close enough, 0.9998 dollars per coin. So very, very close. Again, we're looking at the last 7 days, and we see a low of 0.999931 and a high of 1.0004. So again, very close. If we pull this out, we got the last month, we got the last year, and the lowest in the last year, we've got 0.999 and $1. So they're not even including the extra decimals here for these. But yes, effectively speaking, even with these dips and spikes, we're staying right around that $1 range. Now, in contrast, here we have Bitcoin, which is standing at around 118,000. This is over the last 7 days as well, and we've got $122,000 peak right around here, and around a $116,000 at its lowest right here. So, this really kind of goes to show you the difference between these two types of assets. Bitcoin, it trades based on whatever the supply and demand is. If people want it, the price goes up. If people are not interested in it, the price goes down. Or if more people are looking to sell, well, then the price goes down. But these stable coins, these really are what we've been talking about here in this video. And these new regulations are really meant to just make sure that these stay even more, stable. Now, before I head out here, I do just want to make it clear that I am not a financial advisor, and all of the information here is for entertainment and educational purposes only. There is no way for me or anyone else to know exactly what's going to happen with any security that you may or may not be investing in. So make sure to always speak with somebody who is certified, that knows how to walk you through exactly what the risks are associated with whatever security you're interested in investing in. Because remember, past market performance does not equal future performance. So what are your thoughts on the Genius Act? Is it a win for crypto investors or a step in the wrong direction for what crypto is meant to represent? And as always, don't forget to like and subscribe for more deep dives into the ever-changing world of finance. Until next time, peace.